Hello, today we are going to cover a clause on inventory. So now for inventory, the clause 2 of the CARO is applicable. And here the two things which are majorly required is firstly physical verification, and the second point is about working capital limits. Now working capital limits are also quite important here, and this forms a very important point from exam point of view. So first of all, it is about physical verification. The physical verification of this inventory should be conducted at reasonable intervals. Now, whenever we are talking about inventory, the physical verification by the management should be done, and this physical verification should be covered at reasonable intervals. And here we have covered it here properly. That is, the physical verification should be done at reasonable intervals by the management. The auditor also needs to check the coverage, that is, if entire thing has been covered properly, and the procedures which are applied for the verification, if in the auditor's opinion they are appropriate or not. Then the next is the discrepancies. With regards to discrepancies, if there are discrepancies of 10% or more, that is between the physical verification and the records which are maintained. So if there is a discrepancy of more than 10% in aggregate for each class of inventory, now there are different classes of inventory like the finished goods, the WIP, and the raw materials. So for each class of inventory, if the discrepancies are more than 10%, not equal to but more than 10%, like equal to as well as more than 10% in aggregate, then they need to be, if it has been noticed, then that needs to be stated, and if they have been properly dealt with or not, if it is properly dealt with or not in the books of accounts. So what all do we need to check? We need to check the physical verification at reasonable intervals by the management. The auditor needs to check the coverage and procedure, if it is appropriate in the opinion of the auditor or not, and if there are any discrepancies which are more than 10% or 10% in aggregate for each class of the inventory, and if they are properly dealt in the books of accounts or not. Now the next part is very important, which is with regards to working capital limits. Now the working capital limits are the overhead facilities which are provided to any company or any entity, and it is usually as a security against the current assets. Now these current assets, a major part of them is also the inventory. So this part is covered here, and this is a major statement which is made in the CARO with regards to inventory. So here the auditor needs to report that whether at any point of time during the year, like for any point of time in the year, in the whole year, at any point of time, the company has been sanctioned the working capital limits in the excess of 5 crore, that is more than 5 crore, not equal to but more than 5 crore at any point of time. Like this is the whole year, at any point of time during this whole year, the working capital limits of more than 5 crore has been sanctioned or not. This is particularly from the banks or financial institutions as a security against the current assets. So during this entire year, if a working capital limit of more than 5 crore has been sanctioned as a security on the current assets from bank or financial institutions or not, and this needs to be stated particularly, and we also need to state whether any any quarterly returns or statements which are filed by the company with these banks or financial institutions, if they match or not with the if they are in agreement with the books of accounts of the company or not, and if it is not, then we have to give the details. So if we revise this quickly, now during any point in the year, if the company has been sanctioned the working capital limits more than 5 crores in aggregate, that is like during the entire year more than 5 crores, so it can be 2 crore or 4 crore during the entire year. If it is more than 5 crores in aggregate from a bank or financial institutions on a security against the current assets, then we have to report that. And if the quarterly returns and the statements which are filed with the banks or financial institutions are in agreement with the books of accounts, and if they are not, then we have to give details.